We're recording. And is that sound all right, Alex? Good man. This is exciting, Jonathan.
Not bad. I've got a client meeting after this, actually, and it's already 4 o'clock.
And then we've got a curry.
Then we got a curry.
I'm well excited. Proper old-fashioned white tablecloth job.
We had a family outing to the local curry house on Saturday with some other families nearby. 6 o'clock. So there were, how many adults? 6 adults and 6 kids under 6.
And did the kids eat curry?
Well, they had some korma. Some ate more than others. George, my boy, to be fair, he did try a few. He did try something a little bit more exciting.
Charlie's a bit fussy with certain things, but he likes curry.
Yeah. Yeah. Well, George likes trying things. Weirdly, his favourite food is olives. He's a big fan of strong flavours.
He's a Waitrose child, isn't he?
And he doesn't like chips. He doesn't like chips.
Do you like caviar?
Probably if he tried it, but funnily enough, the Raymond household indulge in caviar.
So Charlie, poor little guy, was allergic to dairy and to eggs when he was younger. So that meant my wife couldn't eat, when she was breastfeeding, she couldn't have dairy or chocolate whilst for 9 months or whatever it was.
Ooh.
I know, it's quite tough.
That is tough.
But as a result, he's fine. Funny enough, he's fine with chocolate. He's happy with that now. But he hates cheese, so he won't eat pizza.
Oh, that is tough because you go to parties and that's all they serve.
Correct. And Lily, because she just adores her big brother, also doesn't eat cheese.
Oh, well, we're getting some of that from Isla now. Very much a case of I don't like it just because George doesn't like it.
It's lovely, but it's also very annoying.
Very annoying, yes.
But there we are. Anyway, the listeners don't want to listen to us witter on about food intolerances.
No, the big question of the day, Husey, that we're going to attempt to answer is, are we in a bubble?
Ooh.
Because that's all I've been asked all week, because the press, in their infinite wisdom, have been writing articles about we're in a bubble.
Yeah. I said, I just before we came up, I had an email from a client which said, we're now clearly in a bubble, so I want to take some money out of tech. So I was quite pleased that the press had convinced her and everyone else that we're now in a bubble. As we know, if everyone thinks the same thing, it's probably not true.
Probably not true, no. Well, we've got some charts to see if we can answer that question.
Yeah.
And we'll also reference a very good article that Ben's written. So,
and I think also we won't know if you don't know you're in a bubble until after the event.
Correct. So, and it can go on for a very long time.
I've given listeners the answer before we run through it, but let's
they can stop listening then, can't they?
Let's run through it.
Good. Hi, everyone. Welcome to Taking Stock After the Bell, episode 56, loosely entitled Bubble Watch. Remarkably, despite the US government being in shutdown and there being no US economic data of note whatsoever, there's quite a lot to talk about.
There's an awful lot.
And people aren't talking about the US government shutdown, which I think is quite interesting in itself. But the world keeps turning. How long did Belgium go without a government? 9 months.
Is that right?
Yeah. Yeah. Coalition collapsed and they went from, well, I mean, it's happening in France now.
How many prime ministers has France had now? 4?
France has now had more prime ministers since the Second World War than Italy has. Italy held the record. And it was something like 1 every 2 years.
I think France has had 4 this year.
Well, the guy who stood down is now back, right?
Yes.
Good day for French assets, though, because...
The CAC's up, or CAC 40.
So 2%.
It is. What was that driven by? LVMH?
No, that's driven by, yes, LVMH is up 11%, but also the news that he's now back in government as Prime Minister, I think. Anyway, we do have a list of things to talk about. So question number 1, Husey, are we in a bubble? So Exhibit A.
Yeah.
Friend and learned colleague, Ben Barringer, tech analyst extraordinaire, he's did an article which has gone on our website and down socials, etc. I might put the link in the email when I send it out. Tech stocks, chart here, tech stocks since 2020 in yellow versus the global equity market in black.
Yeah.
And tech clearly outperforming. Tech is up 320 odd %, and wider equity market is up 200%. So one might say that tech's done very well. A few charts from our research partners, ASR, Absolute Strategy Research, that I noted this morning and sent around. The US equity market as a whole, there are 3 different types of valuations here on this chart. And what we can see just by eyeballing it is that valuations are, should we say, elevated, almost as high as they were in 99.
On one measure, yes.
Yes, exactly. Not on all measures.
So valuations are elevated. If you compare a simple PE, valuations are nowhere near where they were in 99.
Not far away though. 23 times. This chart shows the black line here is the S&P 12-month forward, 22.8. They got to about 25.
Yes, but I think in 99 there were the larger tech names were on much bigger multiples than our tech names today.
And then this next chart that they did, slide 5, Alex, this is the distribution of companies by PE. So the red bits are the expensive companies, and then it sort of graduates down. And they're quite similar, aren't they, in terms of the distribution of the companies with expensive valuations. But it's not quite as concentrated. So you're right. In 99, Cisco and Microsoft were on 60 times earnings. There are no companies that are on that ex-Tesla.
No.
That doesn't really count. So you've got NVIDIA and Microsoft on 30, 35, which is not by any means cheap, but it's not silly.
Yeah, I think my instinct is we're not in a valuation bubble. We might be in an earnings bubble in terms of the CapEx spend, not the CapEx spend as such, but the earnings that the larger companies are generating and the margins they have and the moats they have, but also the market share. That could be slightly bubbly because there's going to be more players coming in trying to take market share. So those earnings, I think my concern is the earnings, and most people's concerns, and you know, we discuss it day in, day out, is can earnings continue to grow at the same rate to justify their current valuation? I think that would be my, you know, that would be my concern. Looking at the charts, what do you think?
Yeah, that's fair. So we ASR, they've actually given us a rather handy forward earnings growth chart here on slide 6.
Okay.
So the US market as a whole is set to grow by 13.4% over the next 12 months. And you can see that line is ticking higher. If you exclude the AI hyperscalers, as they call them, the rest of the market is growing at 9.4%. And therefore, if you back out what the hyperscalers are doing, they're growing at 23.6%. So the question is that 23.6% sustainable? I suggest not.
Yeah.
But at the moment, there's no sign of them letting up, which leads me neatly on to this rather amusing graphic that Bloomberg somehow put together for one of their news stories a few weeks ago as to the web of intricacy in the whole AI story. Yeah. And basically, you've got OpenAI and you've got NVIDIA, you've got AMD, Oracle, Intel, Microsoft, and there's all these kind of cross-shareholdings, investments, people supplying other people, people investing in other people. Yeah. And that sort of, in Ben's sort of article, he does kind of allude to the fact that this sort of late stage stuff is a bit worrisome.
It is. I think up until now, the spending CapEx had been through cash flow, free cash flow generated. So it wasn't the same as 99 when a lot of the growth was being funded through debt issuance, just leveraging up balance sheets. Oracle has issued some debt recently, which was the first time that we've sort of seen it across the majors or the hyperscalers.
I think Meta have done some debt as well.
They have. I think actually Oracle's might have been private debt. I think Meta was was that listed debt?
I think it was. Now.
Yeah, but either way, up until now, the funding has all been done through free cash flow, which that's fine. That doesn't worry us because investing, businesses that are growing very quickly, that are investing in themselves, that are achieving exceptionally high returns on equity or investment, that's great for shareholders. I think issuing debt to fund CapEx spend investment going forward. That does worry me a bit more. Not enough to say let's run away from it all, but it's sort of another tick, or it's another area to monitor, and the funding by Nvidia to various customers, I guess, that are promising contracts to Nvidia to buy chips. That's
getting into a bit shady.
It is a bit.
I think,
but I also, and we've talked about it a lot before. All these management teams have read the same books, which is you have to invest, otherwise you'll be left behind.
Yep.
So if you were Nvidia, it sort of makes sense doing what they're doing. They're spreading their tentacles because they have been caught out before. They had an amazing run through COVID. Demand for chips was, if you remember, was mostly through Bitcoin mining.
It was, yeah.
And that's one of the reasons why the chips are so sophisticated. And they've got to a stage now where obviously it's compute power, but it's powering AI. They probably, that's probably quite when Bitcoin mining and the whole sell-off happened, that's probably quite scary for the management team. They probably want to diversify and have a bit more control going forward. If I was Nvidia, I'd probably be doing the same thing. It's certainly above my pay grade. But
it all sort of, to me, comes back to the question: are we all going to be paying $10 to $20 a month for ChatGPT or Gemini or another AI product? And at the moment, OpenAI, I mean, I use the free version. I'm sure most people do as well. There's no real limits on how much I can use it. And I'm sure those limits are coming, the sort of so-called freemium version where you can use it or you get a lot of ads, but they've not monetized it massively yet, have they?
No, but I'm going to push that question back because I completely agree with you. But how long did we say, for how long have we said how are Meta going to monetize WhatsApp and Instagram? And when are we going to have to pay a subscription for those sites? Apps. We never have done. There was talk of WhatsApp. I'm sure at one stage WhatsApp you had to pay 69p to download the app or something, or 90. But there's never been a membership or version where you've had to pay to use it. It's been done through. They've monetized it in other ways.
Yeah, but I mean, if OpenAI is spending hundreds of billions of dollars on chips and data centers, they're going to have to get that money back from somewhere. Yeah. So, is the advertising model going to work for them? I mean, the whole internet economics is built on advertising, right?
Totally.
Google and Facebook,
yeah, totally,
et cetera, et cetera. And I think, as we've said before, we use Copilot through work, and that probably finds its way back to OpenAI because that's the partner for Microsoft. That you do need big uptake and big revenue streams, whether that's through ads or through subscription costs. So I don't know.
And obviously on Google, people buy advertising space, don't they? They buy search, to be at the top of the pops. Basically, it's OpenAI and other large language models don't use data in the same way. The answers you're getting are not. And I think I read a really good article recently around how large language models are really impacting website hosting, and the amount of traffic going to each website has fallen massively.
Yep.
So if you're hosting a website, advertisers are prepared to pay less to you because the amount of hits going through is
because
much
you're
less.
just getting the answer from Google Gemini.
Correct.
Or you're going straight to ChatGPT.
So there is, that's
disruption.
Yeah. Do large language models need to pay websites in some way for the information they pull off or not? Because otherwise there won't be any websites left.
Well, made the point about books. Basically, Facebook or Meta have taken every single book ever written and copied it basically into their models, and that is the sort of basis of all of the knowledge that they'll use. I mean, they've not paid any of the authors.
Well, that's what I was going to ask.
And it's the same with Reddit, and it's the same with Google. Like that's where the information has come from. But you'd be pretty cheesed off if you're an author on, I don't know, the great whale boom of the 1840s. Let's say that you wrote the definitive account of that, and it was a doorstop book. And then when you go to Meta's AI and ask it about the Great Whale Boom, basically copies and pastes a short version of that book, you'd be pretty cheesed off, wouldn't you?
Yeah, totally.
So lots of questions.
But I think that has to be dealt with at some point, and the people providing the information or hosting the websites or the authors need to be recompensed for that, because otherwise no one's going to create anything going forward.
We might need an AI expert to talk through some of those ethical dilemmas of AI. I will come back to Ben's piece, though, just to sort of the conclusion is the current environment requires a higher degree of selectivity, and we are focusing on stocks and sectors where there's growth at a reasonable price, not any price, and some caution should be heeded in some areas. And that's a really, really sensible kind of conclusion, right? So we're not, as a firm, we're not gung-ho on these things. We've got some selective exposure, what we think is right, but not too much.
I think as a house, we're inline technology, aren't we?
We are, yes.
And Ben's been very, very good and sensible on the picks. We haven't chased, as you say, sort of the really growthy, very expensive areas. It's been more about what cash flow is actually being produced. The multiple businesses are on, where the opportunity is, and
the core stocks.
Correct.
Fine.
Yeah.
So the long answer, the short answer, sorry, to is the eye in a bubble. No, not yet.
No,
Might get there. Potentially controversial opinion. Gold. The number of articles, emails, and podcasts I've been listening to about the gold price suggests that might well be reaching bubble territory. Got a 20-30-year chart here of the gold price. In the mid to late 90s, the price was about $500 an ounce, dropped to about $300 in the noughties when Gordon Brown sold all the UK's gold. Peaked at 2,000 in 2011 and then fell to 1,000. So we had a 50% drawdown in the 2010s. And then it's gone kind of parabolic since 2024. So today it's just hit $4,200 today, I think, pretty much.
Yeah.
So really big move. And
is that adjusted for? Is that in dollars?
That's in dollars.
Okay. So if we're in sterling, it doesn't look quite as extreme of late, but might have gone up further.
Yeah, it looks pretty extreme. Yeah. It looks similar. So I thought I'd go into Google Trends, which I don't do very often, and I typed in the gold price, and this was the Google Trends going back 20 years. And we can see current search interest in the term gold is at an all-time high. So this comes back to my point about maybe gold. Maybe
gold's run a long way. And I've certainly had more conversations about gold with clients over the past 2 weeks than I probably have in the last 5 years. I would have thought
it's a very difficult asset because it could be construed to be an inflation hedge, but it's not really. It could be a things break hedge. It can be a hedge to equity markets, but not always. So that what drives gold? Well, the things that drive gold vary over time. So it's not, anyway, so that's maybe one for another day. But basically, gold is near a bubble in AI, in my humble opinion.
Yeah. Makes sense.
Good. Now, we had Karen Ward, Chief Market Strategist of JP Morgan, in this morning, didn't we? She's been on the pod before. She's very good, but she's way too busy to come and sit with us for another hour and talk stuff. I didn't listen in, Husey, because I was with a client. But you've hand-picked some sweet charts for us. Yeah. So the first one we're going to put up here is on fiscal and monetary stimulus. So the left-hand chart of these two, we've got government debt as a proportion of GDP. Yeah. Lines are high and rising. In fact, the UK doesn't look quite so bad as the US here, does it? Which is by far the worst.
No, we're a lot lower than the US.
Yep.
I mean, a lot of that US debt creation was obviously over COVID with helicopter payments, and I think families of four were getting circa $8,000 to $10,000, weren't they, a household, and that sort of definitely fueled the consumption boom and inflation problems after.
And then the right-hand chart just shows interest rates in the US in black and Europe in purple. And the current trajectory has been down, and the market expectations are for a few more cuts in the US. So am I right in thinking that the sort of conclusion to the two slides was there remains fiscal stimulus and monetary stimulus at the same time?
There is. I mean, this is partly why markets have been so good. The right-hand chart showing federal funds rate and ECB deposit rate in terms of the cuts coming. Companies and stocks typically do well in a rate cutting environment where there's not a recession, or you're not cutting because of real growth problems.
Yep.
No, actually, the Fed is cutting into quite a positive environment. I think we've talked about this before, but this is one of the reasons why stocks have done so well. But essentially, it's this is continued coal being thrown on the fire, and the steam train goes faster and faster at the moment until the coal runs out, or something happens. But for the moment, it's a very supportive backdrop.
Yeah, no, totally agree. And then and we're seeing that from companies, aren't we? We won't necessarily talk about company results today, but we've had financials in the US, JP Morgan, Wells Fargo.
Yeah, I mean,
all good, right?
Yeah, talking about tech, it does. Yeah, as we've said, it's a tricky topic at the moment. But the companies reporting yesterday and today, the numbers, there is a broadening out in earnings. I think the last few earnings seasons away from tech, things have been a bit subdued. Earnings growth has been a bit lower than we'd have liked. I think we've had LVMH numbers today, which look good.
Very good.
As you say, you point out the banks. JPM yesterday looked very strong. I think Citi's numbers were very good.
They were.
Goldman
Wells
Sachs
Fargo,
is.
Goldman Sachs. Yeah.
It
BlackRock.
is broadening out, and
Yeah.
that is really positive for markets. We don't want one sector to drive everything. So, if someone said tech does nothing for a year, earnings catch up, but valuations don't do anything, but it's a broadening out. I'd be delighted.
Absolutely right. Yep. Well, I think we'll probably next few weeks, earnings season starts probably big time next week, doesn't it? But probably 2-3 weeks, we might probably go sit down and go through it. But what's your next choice chart from Karen?
I think we're going to 6, weren't we?
Tariffs?
Tariffs.
She was big on the tariffs, wasn't she?
She was, and she has. I think the market's pretty split on this between, on the impact of tariffs and inflation. Her view is we haven't seen the impact of tariffs on inflation yet. The right hand chart of slide 6, we've got a small increase in US import prices, and that's just coming through. There's a lag to it in her view, and part of the reason is US customs haven't got the systems in place to properly check the tariff rates. That can't just happen overnight. It's a very difficult way to calculate it, and it takes a while to get. I mean, goodness, think about Brexit and how long it took us to get.
Yeah, I hadn't thought of that.
Those sorts of
literally haven't got the manpower.
They haven't got the manpower. They haven't got the systems. They haven't got the tools to do it. So, there's another good example. I saw a portfolio manager last week that lives in the US, and he said he'd ordered an item from what he thought was the UK, which has got a 10% rate for them. And he ended up being whacked with an EU tariff rate, which was 25, 30%, whatever it was. But he said the product was put together in the UK, but the raw materials came from Germany.
Oh, right. There's a transfer pricing.
There is a transfer pricing, but he said that wasn't clear on the website. So there are lots of things. They're sorting a lot of this out. So some of this tariff impact is certainly not seen in the inflation data yet and pricing data. So her view is this, there will be some ugly prints. I think we talked about it before we started recording. It's, these will be transitory, but in the short term, they're inflationary.
They are. And whether, we had the so-called transitory inflation back in 2022, and it took 2 years, 3 years to wash through the system ultimately. And ultimately it did. The question we don't know about is whether market participants freak out about higher inflation prints in the short term and reprice bond yields or reprice bonds down, bond yields up, and whether that has an impact on the equity market and on the Fed.
Yeah.
So, how did the Fed react? At the moment, as we alluded to in the intro, there's no data. So the Fed can't do a lot because there's no inflation print. So we don't really know. I mean, what happens if we get a delayed inflation print and it looks horrible, and there's huge amounts of evidence of tariff inflation coming through the system, And then on the micro, you get some companies saying, well, we're being hit by tariffs and it's costing us this and we're having to put our prices through. And if Walmart say that, then the market maybe freaks out.
Well, the Fed have to reverse course? And then you've got the president saying rates still need to be cut.
Yeah.
And the Fed chair saying, well, we have a dual mandate, employment and inflation is very uncomfortable.
Yeah. And maybe the employment picture improves because, as Dario at Lombard sort of talked about, part of the reason why the labour market has looked a little bit softer was because of the delayed impact of the April tariff announcements and companies putting plans on hold and
totally.
not hiring people. Now, if they decide actually things are fine,
that wasn't cancelled; it was delayed. So yeah, I mean, we could. She wasn't going as far as that, but she thinks the market doesn't have inflation in its top 10 things, I think, or top 5 things to worry about. And actually, she doesn't think that's right.
Okay.
And the only thing I would say is in 21, she was quite early.
She was early
on the inflation call.
I remember.
And it was quite an unpopular call. And
we had Mike Bell on, didn't we? Who was her colleague.
Yeah. And she was, they were very right and very early.
Yeah.
So I think it's worth listening to. I'm not saying it's right, but I think I've got a massive amount of respect for Karen. I think she's superb. So if she thinks we should be thinking about it, then
agreed.
About it.
And then your final choice slide from Karen's slide deck: German fiscal stimulus.
Yes, indeed. So this is, one of the reasons the US, I think, has been such a strong market for the last 10 to 15 years has been to do with the US's kind of fiscal position of being very supportive. Germany in particular has run a much lower debt to GDP. Obviously, there were changes earlier in the year when they've agreed to lift the percentage of debt to GDP. I think they're currently about 60%.
Yes, about that.
And they're moving up to 80.
Yep.
So
still lower than the UK.
Still lower than France. Yeah, totally. But that money has to go somewhere. And actually, if you look at the chart, slide 8, the chart on the right-hand side, 22 to 26, the period, it's showing that government investment as a percentage annualized change in the Eurozone is increasing quite dramatically. So this could be really quite supportive for European stock markets. And Germany in particular. And we've seen
that. Yeah. And we've seen, I think we put the chart up last time or the time before of European markets have significantly outperformed US equity markets year to date. The drivers of that have been, the defence companies, because they're part of this is rearmament, but also secondly, the banks. And the banks, the big contributors have been Commerzbank, Deutsche Bank, but also Santander and UniCredit in Italy. But, effectively most of those are beneficiaries of German fiscal spending. More money in the system, more loans, more, good news.
Yeah. And Germany's infrastructure is really creaking. There needs to be big money invested.
I've never been to Germany. They said Berlin is a really good weekend.
I haven't done Berlin.
No. I wouldn't mind driving the Autobahns either. But there we go.
In the VW ID.
ID5.
ID5.
No, maybe something a bit more life in it than that. No, that's interesting. So we'll see how that goes. But the money is going in now, right?
It is. And I think as a starting point, I think listeners might have sort of listened to the beginning of being a bit cautious and, things are looking a bit toppy. I think, if you look away from the US, there are lots of opportunities as a valuation starting point. And it's not to say the US isn't still a great market to invest in. It's just there are parts of it that are more expensive than we'd like. We want everything, don't we, John? But the European markets on a PE basis and relative across sectors is looking very attractive, as is the UK, as is parts of emerging markets.
Leads me on neatly to an email I received from Ross Yarrow, who's a broker at Baird, and he sends emails out. And he's the biggest bull on US markets and large cap and growth and tech. And he's been talking about Palantir Technologies for a long time, which he's owned himself. Anyway, he sent an email last Friday morning and I literally nearly fell off my chair. The title was everyone. Hang on, where's the title?
What did you see first, my text or the email from him?
I think I saw the email from him.
Did you?
Yeah,
Okay.
and it said UK small caps worth a look. Open brackets. Don't hate me! Exclamation mark. And basically, he comes up with a load of reasons why everyone hates the UK, and I'm going to read them out. And maybe you can flash it up, Alex, if you want. But number one, literally nobody I know has a good word to say about the current state of the UK.
It's me.
Present company accepted. Number two, the UK has had 7 consecutive months of negative employment growth. Clearly not good. Number three, the UK now only has 4 stocks in the top 100 biggest stocks globally. 4 in 100.
That is mind blowing.
Can you name them?
Astra.
Yep.
Shell.
Yeah.
Shell.
Big Bang.
HSBC.
Yep.
Rio. BP.
Unilever, isn't it?
Actually, probably is Unilever.
Yeah. Unilever's the 4th biggest. There we go. 4 stocks in the top 100. Rubbish. Point number 4, millionaires are fleeing. And for all these points, by the way, he's got charts to back all this data up rather than just randomly spouting nonsense.
You're not fleeing.
I'm not a millionaire. Very good, Yuzi. Bond yields flying, i.e. bond yields in the UK have been rising faster than others.
That's really unfair.
Well, they've been going up
At the
arguably more than others, but yeah, I take your point. They've come back down again.
At the long end, and that's a demand-supply issue more than...
We don't need to get into the technicals of the long end of the bond market, but
fine.
yes, yeah. So that one's maybe, okay. Number 6, and there's a lot of these charts doing around, UK electricity prices amongst the highest in the world.
And that doesn't make any sense.
Well, it's idiotic. I mean, it's purely a function of bad energy policy, not just for the last 2 years, but for the last 20 years. And coming home to roost.
That makes no sense. That just shouldn't be the case.
I think electricity prices here are 50% higher than the US. I think we pay 30 pence a unit. I think the American equivalent is 18 or 19 pence. It's laughable.
But it's not as if we don't have any resource. You know, we have
wind,
massive wind farms,
oil, gas. We had coal. All right, we're not going to burn coal, fine, but
solar might be an issue in the winter. But we've got massive wind farms, North Sea oil, as you say, which basically oil and gas companies are fleeing from because of
tax.
You've got to incentivize. Anyway, move on. Next point.
Number 7, debt to GDP is at a 60-year high, as we've already seen. 100% of GDP,
yes.
Not as high as the US or France, but still pretty high.
Mm-hmm.
And number 8, tax revenue as a percentage of GDP at record levels, i.e. the tax take is very high, which means that the economy has to pedal very hard to pay the tax.
Let's come back to that, because that's an interesting. No, that's an interesting point.
And then there was a report last week, actually. The UK has fallen out of the top 20 IPO fundraising companies.
Yeah. I saw. Is it Egypt have more IPOs than us?
No, I think that's right. Yeah, not good.
No.
And number 10, can sentiment get any worse? And then the next chart, we've got the snappily titled Deutsche Numis Alternative Markets Index excluding investment companies over 20 years. And it's down over that period, having fallen a lot in the last 3 years.
Yeah.
And Ross was just pointing to the tentative increase that we've seen in the last few months, which I've helpfully circled in red here. So these stocks are pretty cheap as well and have fallen a long way.
They are cheap, and if you compare the UK market to lots of international markets, you've got very good corporate governance. Most companies operate with shareholders first, kind of in their mind.
Mm-hmm.
It's about creating value. We've got the best legal framework in the world. Yeah, I know the employment data, as you pointed out, has looked slightly messy recently, but ultimately unemployment is still very low.
Growth is okay. It's not
Growth's
terrible.
fine.
1.3.
Inflation's 3.8%. It's a bit higher than we'd
Go
like.
up a little bit to come back down again. But it's not dreadful.
The backdrop, the landscape is not horrific, and that's his point, isn't it? Which is there are still some really good quality little businesses or decent sized businesses that are trading exceptionally cheaply. So
as we are seeing with all the takeover activity, as we discussed last time out,
and with the global flows and global funds that are investing, it wouldn't take much to really re-rate these companies.
Nope.
You know, if the other problem, talking to friends about this or colleagues that run money as well, you know, if you want to buy a position in one of these companies, you can't buy it. There's no stock.
No stock, no
So
liquidity.
you can move the price 10, 15, 20% just to try and to get a position. So
well, the bad news is that you can't get out either, mine. So it's a double-edged sword. That
true, but if you get any wave of net inflows, you know, say you know, people are buying trackers, you know, 250 trackers, that market's going to move pretty quick.
To move. Yeah, agreed. Even the bottom end of the FTSE 100 companies, you know, if you're trying to deal in a 3 billion market cap, you're struggling.
I think I think BlackRock had results yesterday. They're now running 13.5 trillion.
Yeah, it's a big number.
Big number.
1,000 billion.
So
a trillion.
Yeah, they probably couldn't buy. Yeah, they could probably buy the whole of the FTSE. There we are.
So there we are. So Ross Yarrow, not a man known for his natural bullishness on the UK, turns bullish on the UK. Hold the front page.
And as we know, share prices turn a long time before kind of earnings and news comes through. So typically 9 months before the actual data. So if we don't need much for these prices to turn things to get more attractive.
We talk occasionally, particularly when guests on, about when we started out and how we think that might have affected our investment psyche. Generally at the end of a pretty average bull market.
Yep.
Before the financial crisis, which obviously took its toll. Robert Armstrong on the FT, who has given us permission to share some charts and things, wrote a very good newsletter last week, which made me stop and think, and I had to go back and reread it a few times. But basically, there was a comment below one of his articles that basically said that reading the FT since 2009 had made whoever this person was, basically sitting cash waiting for markets to fall because he'd been, put off by reading all these bearish articles in the FT. And that period went on quite a long time, didn't it? Because we had the crash was in 2008, 2009 was dreadful. Then we had the Eurozone debt crisis straight off the back of it, 2011, 12. And then we had another mini sort of wobble in 2015. So it was quite a difficult time. But anyway, so Rob Armstrong was saying, legitimate criticism, and the good people at the FT did this chart where they went back through 3 million articles that's been published in the FT since 1980, and they came up with a composite sentiment index across time. And that is given here on this chart. And there's a sort of line between positive and negative. And we can quite clearly see that the period 1980 to 2005-6 was wobbling around that naught line, positive to negative.
Sounds right.
And then obviously we had the 2008 crash where sentiment went very negative, but interestingly, it never really recovered.
No.
So FT article sentiment remained negative for the last 15 years, with a few negative drops for Eurozone debt crisis and Liberation Day and COVID, etc.
And I have to say, I used to really enjoy reading the FT.
I still do.
I read it less so I always have it. But I do find it makes me very negative. There aren't many exciting sort of ideas or articles in there. So that would make sense. So it has become a very negative newspaper.
But I think he goes on to sort of explain, well, why might this be? And there's a few reasons he comes up with. One, the journalists themselves were scarred by the financial crisis, maybe in the same way that we were. Secondly, the modern world of moving away from people buying newspapers to putting stuff online that's driven by advertising. When you do that, all you're interested in is the number of clicks your article is going to get.
Yes.
And effectively,
negative sales.
Bad news sells much better than good news. Yeah. So if you want someone to click on your article, then you make a headline like, "We're in a bubble. It's all going to blow up."
Is that why?
That's why we're talking about bubbles.
Our podcast called the Bubble Territory.
Exactly. Yeah. So maybe it's not just the FT have gone kind of dark in the last 15 years. Maybe it's just the evolving media landscape. And that's what you have to do to generate clicks and generate revenue and make a viable business model. I don't know. But this has made me think, a huge amount. And if anyone's got an FT subscription, or you can register to get some free articles, then do go and have a look.
So are you grumpy because you read the FT every day?
There's lots of reasons why I'm grumpy. The FT may or may not be part of it. I don't know what to say.
You did a round of applause button.
Well, that's not all working. So anyway, I thought it was really interesting, and don't underestimate the impact of psychology, human psychology, on markets.
I mean, we sort of know this because, I think we steer clients through various cycles, and it's not about us just maintaining positivity, because we wouldn't be doing our job if we did that the whole time. But I think you have to think outside the box and away from these articles sometimes, and really push and question what journalists are writing.
Well, I mean, ultimately, the stock market, we've got 150 years of history. It starts in the bottom left and it ends in the top right. Yeah. And you have to have when we've had world wars, pandemics, we've had all sorts in that time, depressions, panics. And despite that, the line goes up and to the right. So if you don't believe that, and if you don't believe in human progress and human endeavour, then the stock market's probably not for you. Go and buy some gold.
No. It's probably why the stock market's going to go up over the next year.
Well, there we go. So are we in a bubble, Husey? Not yet.
Not yet.
Unless it's a gold price. But
no, the positive for me is this broadening out. You know, actually, I sent you my prediction, didn't I, at the end of last year? I said the S&P was going to be up double digit, but it's going to be a broadening out, and it's sort of might happen by the end of the year. Should we leave it there? Got any exciting plans for the rest of the week other than a curry? Curry tonight with you. Great. Well, I know you're going to criticise me, but I'm actually going on holiday next week for half term, so I've got some very exciting plans with the kids.
Where to?
I'm not telling you.
Okay. It's clearly getting somewhere expensive.
We've got some family that live in
California.
California.
Oh, lovely. Yeah. That'll be nice. It'll be warm.
I'm seriously excited.
15 hours on a plane with 2 small children.
Yeah, my wife's a hero. So
yeah, she is.
I've got a separate seat.
Good. Well,
no, it's very good.
We'll call it a day.
Yeah.
Good. Thanks very much to everyone for watching and listening today. Any questions, let me know. Jonathan.Raymond@quartercheviot.com, and we'll see you next time. Thanks very much.
Thank you.